Hi everyone, hope all are fine. Today we made a video on Ind AS 7 statement of cash flows. Myself Bhargav. Before going into our topics for discussion, remember statement of cash flows presents only cash inflows and outflows during a report period. It means non-cash transactions are outside the scope of Ind AS 7. Now let's go to the today's topics for discussion. Our topic has been divided into 5 parts. First part talks about definitions. Second part, presentation of statement of cash flows. Third part, reporting cash flows from operating activities. Fourth, when to report in gross basis and when net basis. Fifth, how to report special cases. Let's discuss each and every topic in detail. Our first definition is what constitute cash. According to Ind AS 7, cash refers to cash on hand as well as demand deposits. Next, what are cash flows? It means the inflows and outflows of cash and cash equivalents. Last definition, what is cash equivalent? Point number 1. They are short term in nature and highly liquid investments that are readily convertible into known amounts of cash. Next, and are not subject to significant risk of changes in value. There are additional points to remember in cash equivalents. According to definition, they are short term in nature. First question is, what period shall be termed as short term? Ind AS gave clarification that any investment held for 3 months or less from the date of acquisition will be termed as short term. Next, question number 2. Equity investment for less than 3 months shall qualify for cash equivalent or not? Answer is no. Our point number 2 in definition says they are not subject to significant risk of changes in value. Generally, equity involve significant market risk, hence exclude from cash equivalent. Next, point number 3. Normally, bank borrowings are long term in nature. Question here is whether bank would he qualify for cash equivalent or not. Answer is yes, because it satisfies both the points of the definition. Now quickly go through the structure of reporting cash flows. First, take opening balances of cash and cash equivalent as base. Add cash generations during the reporting period. Subtract cash payments during the report period, and the total should reconcile with the closing balances of cash and cash equivalent. Next topics will be concentrating on point number 2 and point 3. So please concentrate. Our next topic is presentation of statement of cash flows. Cash flows ought to be classified into 3 categories: operating, investing, financing. Under operating, report all principal revenue producing activities as well as activities that are not investing and financing. Next, under investing, report all acquisition and disposal of long-term investments and other investments not included in cash equivalents. Last, under financing, report all changes in size and composition of the entity. Go through the examples at your end by downloading the presentation notes or pause now and quickly go through it. Simply, I can classify them as what we do generally in our business during the year will be operating. Any expansions in the form of production capacity or setting up new branches or any business combinations will be investing. Fund that guide operating and investing will be your financing activities. Our next topic is how to report cash flows from operating activities. There are 2 methods for reporting operating activities. One is direct method. Under this method, major classes of gross cash receipts and cash payments are reported. Indirect method, it's a reverse calculation process where we need to take profit before tax as base. We need to add back non-cash expenses like depreciation or amortization, because cash flow statement reports only cash basis, not accrual basis. Then any gains or losses on sale of assets has to be removed or add back. Let's see an example why we are removing. Asset costing 10 lakhs sold for 11 lakhs. There is a gain of 1 lakh which will be included in profits, because profits will be reporting on accrual basis, but the entire cash receipt is from investing activity, hence remove from operating and show the entire cash receipt under investing activities. Next, add or decrease working capital changes. See next slide for better understanding. Next, remove other investing and financing activities like dividends and interest costs. The total of above is cash flows from operating activities. Remove income tax from it, you will get net cash flows from operating activity. Now let's understand this slide with an example. BTutor is a company with sales amounting to 20,000, includes a cash sale to the extent of 15,000. It means the resulting 5,000 will be credit sale. Next, we have purchases amounting to 12,000, includes cash purchases to the extent of 4,000. It means trade payables to the extent of 8,000. Next, salary for the year amounting to 2,000, all cash, and a depreciation amounting to 1,000 on fixed assets. First, we will see how to report under direct method. It says major classes of gross cash receipts and payments to be reported. That is, add all cash receipts and remove all cash payments. From this we got cash flows from operations as 9,000. Now let's see the reverse process called indirect method. Take profit before tax as base, so our profit before tax will be 5,000 as per calculations. Remember, statement of profit and loss will be accounted on accrual basis. So to profit before tax of 5,000, add non-cash expense of 1,000, which is depreciation. Add working capital changes. See working note number 1 above. Working capital changes is equal to current asset minus current liability. There is a trade receivables amounting to 5,000 and there is an increase in trade payables amounting to 8,000. 5,000 minus 8,000, it is negative 3,000, which means decrease in working capital. Why we wanted to add this working capital? Because on receipt side there is a cash receipt on hold to the extent of 5,000, but this has been included in profit, so remove that. Similarly for payables, where 8,000 has not yet been paid, but from profit and loss we have reduced that amount, so we are adding back. Are you clear? After adding all these, our cash flows from operating activities again comes to 9,000. So under two methods, amount will be the same, only computation will differ. I hope you are understanding. Next, when to report cash flows on gross basis and when at net basis. Generally, in Ind AS 7, cash flows will be always presented on gross basis. That is, cash receipts would be shown separately and cash payments would be shown separately. But following cases will be considered under net basis. First case, all entities except financial institutions. Point number 1, any cash receipts or payments on behalf of customers. Point number 2, any cash receipts or payments received or paid on items in which turnover is very quick, where amount is large and maturity is short. Second case, all financial institutions in which cash receipts and payments for acceptance and repayment of deposits with fixed maturity date, placement or withdrawal of deposits with other financial institutions. Last point, cash advances or loans made to customers and repayment of those. Our final topic for discussion, special cases in reporting. Number 1, foreign currency cash flows. Foreign currency cash flows has to convert to functional currency using the exchange rate at the date of cash flow, not date of transaction. So the difference of exchange rate between date of transaction to date of cash flows will be the unrealized gain or losses, which should be included in cash and cash equivalents only. Number 2, interest and dividends. In case of financing company or in case of other company, how to report it? Interest paid. Interest paid for financing company will be operating activity because principal revenue generating activity for that. For other companies, it will be financing activity. Next, interest and dividends received. In case of financial institution, it will be again operating activity. In case of other companies, it will be investing activity. Then last, dividends paid. In case of financing or other companies, that will be financing activity only. Next special case, taxes on income. Always show this under operating activity unless specified to classify in investing or financing. Last special case, cash flows arising from ownership interest, if that result in obtaining or loss of control, classify under investing activity. If it does not result in loss of control, classify under financing activities. Next, additional notes slide for clarifying what is demand deposits, how to report gross versus net basis, and there is an example on foreign currency cash flow. Please go through at your end to understand deeply. And let's recap what we have discussed. We covered definitions, presentation, reporting, gross cash versus net cash, then special cases. Thank you guys. Any doubts, please